When the spot Bitcoin ETFs were approved back in January, the entire crypto market dynamic shifted, and not just because BTC hit a new all-time high. Investors everywhere have been buzzing at the prospect of massive amounts of cash flowing into BTC from institutions. And this begs the question of which ones are getting involved.
Who's involved?
Well, today we'll go over everything you need to know about this institutional interest in the spot Bitcoin ETFs and tell you what could happen next. Stay tuned. Now, in case you're unsure of what the spot Bitcoin ETFs are and how they work, here's everything you need to know. Spot Bitcoin ETFs are financial instruments that track BTC's price. Basically, they work similar to stocks and shares and can be traded on the stock market. Each ETF share is backed by actual BTC held in custody, which provides investors in these shares with a way to get exposure to BTC's price action without having to buy, store, or manage that crypto directly. On the 10th of January this year, 11 spot Bitcoin ETF proposals were approved by the SEC from issuers such as Grayscale, BlackRock, Fidelity, Van Eck, and others, bringing a decade-long struggle to a triumphant close. Now, this was a big deal because it essentially created a bridge between crypto and TradFi. Not only would this attract new retail investors who would normally just stick to the stock market, but it also opened the floodgates to waves of capital inflows coming from institutions. And those waves are pretty big. Back in October last year, Ernst & Young's global blockchain leader, Paul Brody, said there were trillions of institutional dollars waiting on the sidelines for an ETF to be approved. In November, Galaxy Digital founder and CEO Mike Novogratz said that, quote, 2024 literally is going to be a year of institutional adoption, primarily first through the Bitcoin ETF, which will be followed by an Ethereum ETF, which we now know was spot on. And by the way, if you're enjoying the video so far, crunch that like button to give it a boost and subscribe to the channel if you haven't already. Don't forget to turn on that notification bell too so you don't miss our next one. Apologies for the interruption, folks, but if you're looking to get the very best information about altcoins and become part of the most welcoming community in crypto, then we have just the place for you. The Coin Bureau Club is where you can find our unrivaled altcoin reviews. Every week we cover a different low-cap altcoin project, and these reviews are the best in the business. No one digs as deep as we do into these projects, and we share all the info we find with our members. There's tons more besides our reviews, though. You'll also get access to our exclusive research feed, where I and other key Coin Bureau team members share alpha, our thoughts on the market, and more in real time. You'll get to see what we all hold in our portfolios, and there's an exclusive members Discord as well. This is the place where you can chat directly with us, ask questions, and meet fellow crypto enthusiasts. The community there is the best you will find in the crypto space. Everyone is welcome, and you can talk crypto 24/7 if you so desire. There are loads of other benefits to being a Coin Bureau Club member too, so if you're interested, check out the link in the description below. And now, back to the video. So then, it's clear that there was a lot of hype around the spot Bitcoin ETFs in the run-up to their approval. But how did the expectations compare to reality? Well, to answer that question, take a second to consider that the first spot Bitcoin ETF in the US began pre-market trading with double-digit gains as investors scrambled to get a position in Bitcoin. And this momentum continued for quite some time. Within their first week of launch, the spot Bitcoin ETFs had topped more than 3 times the daily trading volume of all 500 ETFs launched in 2023 combined, with volumes quickly surpassing $10 billion. That's a lot of money in just a week. And as a fun fact, BlackRock and Fidelity spot Bitcoin ETFs saw the largest debut months of any ETF in the last 3 decades, with both of them ending up with well over $3 billion each in assets under management, or AUM. In January, US spot Bitcoin ETFs made up 15% of Bitcoin's total spot trading, and by February, the asset managers handling the ETFs were absorbing more than 10x the BTC that miners could produce. So much so that it didn't take BlackRock long to accumulate 100,000 BTC in AUM. And according to a report from CryptoQuant, the ETFs accounted for 75% of new investments into BTC, as in people who weren't already invested into crypto. Just let that sink in. Now, by March, the inflows kept on coming to the point that they pushed BTC to a new all-time high at over $73,000, which marked the first time in Bitcoin's history that a new all-time high had been reached before the halving, underscoring the fact that the spot ETFs have changed the dynamics of the crypto market. But in the weeks that followed, BTC's price dipped significantly as the ETFs began to experience heavy outflows and didn't pick up again until towards the end of March, although their overall trading volumes had actually tripled throughout the month. In April, the inflows began to slow down significantly and even turned into some heavy outflows. This was subsequently reflected in BTC's price, which fell by around 15% that month, from 71k to around 60k. Heck, even BlackRock, which manages the largest spot Bitcoin ETF, saw its investments grind to a halt. Now, market analysts say the reason for this was likely due to rising geopolitical tensions, but, well, let's not go there. Anyway, since then, BTC's price has been a little underwhelming, and that's in large part because of the ETF fluctuations between days of inflows and days of outflows. But generally speaking, there's been more money flowing in than there has been flowing out. Now, as we mentioned earlier, it was generally believed prior to the approvals that the largest portion of capital would come from institutions, and for the first month or so, this was definitely the case. According to a recent Chainalysis report, for the first month after the spot Bitcoin ETFs were approved, the volume of transactions worth over $1 million increased the most. The second largest increase was transfers between $100,000 and $1 million, before professional and retail investors later joined the rally towards the end of February. The report then highlights that daily ETF volumes surged to nearly $10 billion in March, with volumes consistently trading in the billions of dollars. Not only that, but the spot Bitcoin ETFs have massively outperformed the first net gold ETF that launched back in 2005, and as you can see from the chart provided, it isn't even close. In Chainalysis's words, quote, "With billions of dollars of inflows since January the 10th, 2024, Bitcoin ETFs have collectively become the most popular ETF of all time." Now, this begs the question of which institutions are actively involved in crypto through the ETFs. Well, the short answer is there are lots. Back in May, it was revealed that more than 600 firms had a combined investment of over $3.5 billion in Bitcoin ETF shares. This was revealed in the 13F filings reported to the SEC. Now, for reference, a 13F form is a quarterly disclosure to the SEC that's required to be filled in by all investors with at least $100 million in AUM. While it won't be 100% accurate, it's pretty fair to say that the vast majority of investors with that kind of money in the bank will be institutions of some kind. Anyway, some big names on that list include Morgan Stanley, JP Morgan, Wells Fargo, UBS, BNP Paribas, the Royal Bank of Canada, and hedge funds like Millennium Management and Schonfeld Strategic Advisors, to name just a few. And since then, another quarter has passed, and on the 14th of August, another 13F was filed with the SEC, which revealed even further growth. According to an ex-post from Bitwise's Chief Investment Officer, Matt Hogan, the 13F filings revealed that there were more than 1,900 holders of ETFs in Q2, although notably he also points out that this doesn't mean there were 1,900 institutions holding Bitcoin ETFs. That's simply because many holders will report positions across multiple ETFs. But given that this logic also applied in Q1, Hogan concludes that there was actually a 30% increase in holders from Q1 to Q2. He also explains that, quote, "Institutions have mostly diamond hands," saying that 2/3 of institutional investors either bought more or held their BTC positions throughout Q2. More specifically, 44% of asset managers increased their spot Bitcoin ETF holdings, and 22% of asset managers simply hodled. As for the remaining third of institutions, only 21% decreased their positions and just 13% jeeted their bags completely. Hogan commends this hodling, saying, quote, "If you thought institutional investors would panic at the first sign of volatility, the data suggest otherwise. They're pretty steady." He then moves on to say that hedge funds remain big players in the space, with the top holders of most ETFs including the likes of Millennium, Schonfeld, Boothbay, and Capula. Now, while 13F filings have revealed that institutions are more involved in crypto than ever, this hasn't stopped people criticizing the adoption of crypto ETFs. That's because of the current Bitcoin ETF assets under management, only 21% is being held by institutions, leaving the remaining 79% in the hands of retail investors. This is something Matt Hogan again wrote about on X, saying that this doesn't reveal the full picture. In his words, quote, "Bitcoin ETFs are being adopted by institutional investors faster than any other ETF in history. Don't believe the 'it's just retail' story. The data proves otherwise." He goes on to say that the Bitcoin ETFs have pulled in over $17 billion in net flows since they launched back in January, smashing all previous records. He then provides a table that shows the number of institutional holders and the total AUM for several ETFs, and the results are pretty eye-opening. As you can see, the Bitcoin ETFs have around 1,100 institutional holders, around 3x the number of holders of the Nasdaq 100, which falls into second place with just 374 institutional holders. Incidentally, the Nasdaq 100 ETF is slightly higher in AUM, but Hogan notes that this is like comparing apples to oranges. But the key takeaway is that despite the apparent imbalance between retail and institutions, Bitcoin ETFs are gaining adoption faster than any other ETF in history. Now, the recent 13F filings reveal a growing list of firms with Bitcoin exposure, and one of the latest names on that list is investment bank Morgan Stanley, who reported having around $188 million worth of shares in BlackRock's IBIT ETF, making it a top 5 holder with more than 5.5 million shares. It also declared owning around $148,000 in Grayscale's GBTC and around $1.6 million worth of ARK Invest's ARK21 shares. Other recent names include Goldman Sachs, another investment bank, which reported owning around $418 million in ETF shares, more than half being in BlackRock's IBIT. JP Morgan was another name on that list, having reported owning more than $750,000 in ETF shares. As a fun fact, in Q2, Morgan Stanley announced that it would be allowing its financial advisors to recommend Bitcoin ETFs to their clients, namely the ETFs from BlackRock and Fidelity. As a not-so-fun fact, former SEC official John Reed Stark said that this was basically the company's death wish, saying, quote, "Morgan Stanley has just voluntarily subjected themselves to what will likely become the largest SEC and FINRA examination sweep in history." They're such a cheery bunch over at the SEC, aren't they? Anyway, back in Q1, international hedge fund Millennium Management disclosed holding a whopping $2 billion in ETF shares split between 5 different ETFs. Again, BlackRock was the favorite, with over $844 million invested, but Fidelity came in a very close second with $806 million. Senior Bloomberg ETF analyst Eric Balkunas even described Millennium as, quote, "the king of Bitcoin ETF holders." There's also been investment coming from US state pension and retirement funds, including the State of Wisconsin Investment Board, which has invested around $164 million in Bitcoin ETF shares, and the State of Michigan Retirement System, which holds roughly $6.6 million in ETF shares. Even New Jersey's mayor has announced plans to invest in the Bitcoin ETFs for the city's pension fund, although at the time of shooting, he hasn't specified an amount. As you can see then, the number of institutions jumping on board is increasing rapidly. In fact, according to one senior analyst from K33 Research, since Q1, there are more than 260 new firms now investing in the ETFs. And in case you were wondering, the biggest buyers in that time were Goldman Sachs, Capula, and Avenir, which collectively bought around $1.3 billion worth of Bitcoin ETF shares. So then, by this point, you're well aware that the spot Bitcoin ETFs have been a raging success. The next question is now, what comes next for crypto ETFs? Well, let's first answer that question by addressing the small matter of the 8 spot Ethereum ETFs, which were suddenly approved in a surprise move by the SEC and started trading on the 23rd of July. While this was obviously bullish news for ETH, which at the time of shooting has yet to reclaim its November 2021 all-time high, the launch of the spot Ethereum ETFs didn't quite go as smoothly as the launch of their spot Bitcoin brothers. On the first day of trading, the spot Ethereum ETFs saw net inflows of around $107 million and, rather impressively, had over $1 billion in trading volume. However, things took a turn for the worse on day 2, which saw outflows of around $113 million. In fact, inflows have been fairly poor when compared to the spot Bitcoin ETFs, and it wasn't until the middle of August that weekly flows turned positive for the first time since launching. To be fair, it hasn't been a complete disaster. Overall, the Ethereum ETFs have still had more inflows than outflows, but it's been something of a rocky road. This is probably why BlackRock has said that it doesn't foresee much interest on the horizon for ETFs outside of Bitcoin and Ethereum. Despite this, though, Franklin Templeton has expressed interest in a Solana ETF following Ethereum's apparent success, and has also applied for a crypto index ETF too. This would track the performance of the CF Institutional Digital Asset Index, which currently only consists of BTC and ETH. Meanwhile, VanEck's head of digital assets research, Matthew Siegel, also has his sights set on a Solana ETF, saying that a closed fraud case from 2018 could hold the key to a spot SOL ETF approval, despite many analysts thinking that an approval would be very unlikely anytime soon. We happen to think the same, and you can learn more about the reasons why by checking out our recent video. The link will be in the description. Anyway, while a spot Solana ETF might not be on the cards in the near future, there's still a chance that other cryptos could get an ETF of their own. In fact, if you take a look at Grayscale's selection of altcoin trusts, you can get a sense of which cryptos institutions are paying the most attention to. Now, these include trusts for a variety of different coins, as well as a few index trusts for specific narratives. As it happens, we also have a video about Grayscale's altcoin offerings, and you can learn all about which altcoin could be next in line for an ETF in the description. In the meantime, as more investors begin to accept and adopt the existing ETFs, BTC and ETH could be pushed to new all-time highs. It's great to see that institutional investors seem to be happy with hodling through volatility, because the capital from these investors could very well be the backbone for future success. Any additional ETFs for other altcoins would be bullish for the entire crypto industry, particularly for the cryptos in question. However, it remains unclear when this could happen, and that's assuming we don't see changes in the way these ETFs are regulated. Any changes that do come about could not only make the process more difficult, but could even shake up the existing ETFs, particularly if they affect the availability of these products to investors. Of course, this regulation also depends on the result of the upcoming November US presidential elections. If a pro-crypto candidate gets elected, this would open the door to more robust regulations that would allow the industry to thrive. Conversely, if the person elected turns out to be more anti-crypto, things are unlikely to get any easier and could even get worse. And if you want to learn more about how the upcoming elections could affect the crypto industry, you can check out our recent video on that topic too. The link is, of course, down in the description. Okay, and that's just about all for today's video. So if you enjoyed it, help us out by smashing that like button. Subscribe to the channel if you haven't already, and ping that notification bell to help you catch our next one. If you know someone that this video could help, then take a second to share it with them. And if you're looking to trade cryptos on an exchange, be sure to check out the Coin Bureau deals page, where we have some of the best deals in all of crypto. You'll find sign-up bonuses of up to $100,000 and trading fee discounts of up to 70%. We also have exclusive deals on hardware wallets for you to keep it all stored safely too. Thank you so much for watching, and we will see you in the next one. This is Guy bidding you goodbye.